Good afternoon, everyone, and welcome. My name is Matt Vanderloo, and I'm a principal in our healthcare group and also the CEO here at SVA. Thank you for joining us today for our webinar on understanding the true value of your dental practice and what actually drives it. Before we dive into our first webinar here of 2026 in the dental series, I just want to take a minute to share a little bit about SVA and our long history of working with dentists. As a firm, we've been around for more than 50 years, and throughout that time, dental practices have been a big part of who we serve. One thing that's always mattered to us is helping practice owners make smart decisions that support long-term independence, growth, and flexibility, whether that's planning for an expansion, bringing in a partner, adding a new associate, or eventually even transitioning out of the practice. We believe dentists need more than just someone to prepare a tax return. You need an advisor who understands your business, your goals, and the real world decisions and challenges that you're facing. Today's discussion around practice value is a great example of that mindset. As we go through the presentation, feel free to submit your questions in the Q&A feature, and we'll leave time at the end to address as many of those as we can. Joining me today is James Emmerich, who's a principal here at SVA. James is also our valuation expert in the healthcare space. James has spent the last couple of decades at SVA working closely with dental practices, helping owners understand their numbers, improve profitability, and position their practices for long-term success. He'll be walking through what really drives practice value, what can hurt it, and some practical steps that you can take to start right now improving the value of your practice. And with that, I'm going to turn things over to James.
All right. Thank you, Matt. Thank you, everybody, for joining us today. As Matt kind of alluded to, today we're going to talk about maximizing the value of your dental practice, what the business valuation process is, documentation that's going to be required, the different approaches that are used, and then some of the value drivers and what you can be doing now to start creating additional value. So we'll get to all of that in the next 30 minutes. So first, the question is, what is business value? Okay. So when we talk about it, business value is often misunderstood. Most of the time people think about it as revenue and profit, but it's actually a much more broader and forward-looking concept. Value represents the expected future economic benefits that a company can generate rather than what it's earned in the past, right? So it's very forward-looking. It's an analytical exercise and a strategic one because we look at historical data and then we try to project it out and say how sustainable, how predictable is that performance going forward. And we try to make sure that the revenue numbers or the benefit stream that we're looking at is going to be indicative into the future and that the business can sustain it. Okay, so you can kind of see the last box on that, what is business value, the key formula there, that's value is benefit stream divided by risk. Okay, and so what that's really talking about is the future benefit stream. We're talking about future cash flows. What is the actual amount of cash that the practice is throwing off? Well, risk is the uncertainty associated with achieving those cash flows. If you think about it, if you had two businesses, both identical, but one is a little more risky than the other, the one that has more risk is probably not going to be as advantageous to a buyer than one that's less risky. So think about it as benefit stream divided by somebody's risk tolerance or what the risk is for that entity. The valuation process, you can see there's kind of a wheel on the screen. It begins with the discovery phase, during which we collect the financial statements, tax returns, operational information, and we start to review all the info that we get. So this is a critical step because it establishes the factual foundation for the analysis. Okay, so we will typically send out an information request, and the list can look intimidating or a little robust. But it's a starting point for the evaluator to start to understand your practice. And what we typically look for is 5 years worth of financial statements, 5 years of tax returns, an accounts receivable report. We'll probably request a copy of your fee schedule, lease agreements, production and adjustments by doctor, compensation by doctor, new patient reports, and potentially much more. So there's a lot of collecting of data up front that allows us to start to paint the picture of your practice. The second one then is we start to normalize the earnings by adjusting for non-recurring items. We look for discretionary items, some owner-specific costs. What we're trying to do here is we're trying to get the profit of the practice to really reflect a true operating performance. If somebody else is coming in and replacing you as the owner, what is the true profit that the practice would throw off or spin off for that individual? Okay. Then we have to look and choose a valuation method. There's 3 different methods, which we'll talk about. There's the income, the market, and the asset approach. And we got to determine which one's appropriate for yours. The income approach focuses on future cash flows. The market approach looks at comparable transactions. And then the asset approach considers the value of the company's assets and liabilities. And then the last part in that wheel, produce a report with a narrative and exhibits. And that's exactly what it sounds like. The final valuation is more than just the final number. We're really going to give you a package that's going to tell the story of your practice. How is this value derived? Things that we considered. We're going to present exhibits showing you here's what the income statement was or were. Here's what we did to normalize those. Here's some assumptions that were made, right? And we're going to lay it all out so anybody that's reading that report can understand why the value was the value, okay? So then we just kind of transition. We say, okay, so how do we find out what the practice is worth? And oftentimes there's rules of thumb, and then there's the actual valuation analysis, which we just kind of talked about. So rules of thumb are just what they sound like. It's, there's no real narrative that's going to be provided. The valuator spends less time getting intimately involved with the entity. I don't want to say they do a quick and dirty analysis, but oftentimes this is where you start to hear people saying, a practice sold for X times revenue or maybe X times income. You start to hear multiples of EBITDA get thrown around. I know EBITDA has become more of a buzzword. So those are more rules of thumb, really not as much detail as the valuation analysis, where we really take the time to understand your practice, do a little bit more due diligence, get a sense of what's going on. We may schedule meetings with the seller or with the practice to try to sit down and discuss certain aspects of the practice, really gain an all-encompassing view of what's going on with the goal to understand the positive and negative elements of your practice, okay? So what is involved in a valuation analysis? And again, now we go back to the 3 different approaches that are out there. So there's the net asset approach, the income approach, and the market approach. And when you think about how a business valuation occurs, it's very similar to a real estate appraisal. Not identical, but the appraiser goes out there, they look at different methods, different comparable sales, and they come back, they put all this together and they say, okay, this is what we think that property is worth. Well, a very similar approach is adopted in business valuation. The net asset approach, here the appraiser is working to attain value of the assets. So we don't necessarily go out and do an appraisal of your equipment. You could have one done, but we use different mechanisms to determine asset value. And we take a look and say, okay, what's the total asset? What are they worth? And sometimes the net asset approach can be considered the floor for an entity. This is the bare minimum that it would sell for. And what I mean by that is if you were going to liquidate your assets, this is what you'd receive for that. So that's why sometimes this can be viewed as the floor method, okay? The income approach, this method looks at the cash flow. So now we're taking your income statements, we're normalizing them to try to see what is the actual benefit stream or the cash flow that's going to be thrown off to somebody who could be potentially purchasing your practice. We apply a cap rate to the cash flows to help us determine value. And again, remember, valuations are always forward looking, so we're trying to figure out what the future cash flow is going to look like. Is it sustainable? Are those earnings going to be quality? And can they go on into the future? So we're really looking at what the future looks like when we're looking at the income approach. And then last, we have the market approach. And here, we're comparing your practice to other transactions or other practices in the market. So, in the dental industry, we're taking the dental practice, we're comparing it to other dental sales in the market. We have databases at our fingertips that allow us to go through some of those sales, and we use those as guidelines to help us determine a value, okay? We try to right size the value in the database to kind of fit, what your practice is. Maybe we base it on revenue, operating costs, revenue before owner comp, right? We look at certain things, we can pull that data out of those databases and kind of right size it to what your practice is looking at. And here, we might then tell you, okay, we're going to use different metrics, multiple of sales, a multiple of earnings before owner comp. Again, trying to say, here's what's going on in the market, here's what we think your practice would be valued at, okay? And then last, we have historical financial results. Again, we like to look at 5 years worth of data. How is your practice trending? What are the numbers telling us, right? We can look, is revenue growing? Is it decreasing? Is it sustainable? How has it been over the last 2-3 years, all the way back to 5 years? Where is your practice? Where is it going? Those numbers do tell a story, and so it's important that we have those 5 years worth of data. Again, we want to make sure things are moving in the right direction. And then how do you look compared to other practices? You know, we will take a look, compare you to other industry peers, see how you're moving, revenue, how many doctors you have, what's your overhead, how's that running? And those are the things that we start to look at to really paint the picture of what your practice is doing and where we think it's going into the future. Okay, so, you know, we talked about the net asset approach, and on the screen here you see tangible assets. So when we talk about tangible assets, we are talking accounts receivable, supplies, equipment, leasehold improvements. Maybe you own the building, so that could be considered as well. But these are the main things we're talking about. Accounts receivable, you know, what is that worth? Well, that can be determined at closing. Could be based on actual collections. It could be here's what we believe to be collectible, and we make an assumption there. So that's one. Supplies, we take two months worth of supplies. So we'll look at your last year of supplies, and generally we'll see a 2-month average. We'll say, okay, here's 12 months worth of cost divided by 12 times 2. That's how we're coming up with the supplies number. And then the equipment. Again, you can go out and you can get an appraisal on the equipment if you think it's necessary. Otherwise, typically we'll utilize a straight line depreciation methodology where we're taking the equipment, we're putting it into some buckets, we're writing it off over a period of time, and then we're using a salvage value saying, yeah, that equipment, well, it may be older, it still has some value, even if it's fully depreciated. You could probably turn around and sell it for X dollars, right? So we do assume a salvage value as well. Intangible assets, so here's the goodwill piece. Goodwill can be personal or it can be enterprise goodwill. It's really dependent on the deal, how it gets structured, the covenant not to compete. So, you know, this is the right to earn income off a block of patients in the future. Goodwill can be based on gross revenue, determined as a percentage of top line revenue, or maybe we can look at it as based on earnings before owner comp as a multiple of earnings before owner's comp. But really, you know, you have the asset value, and then you have what the practice is worth, and a lot of that falls into the area of kind of goodwill, saying, what have I truly built here, and what is this practice worth? Okay. Next, what is involved in the valuation analysis? So here's where we really start to understand the practice, and some of this I've already mentioned. So, you know, the key metric here is revenue growth. We want to see growth. Is it moving in the right direction? Is the arrow pointing upward? It's the 5 years of financial statements here is critical because that can really paint the picture and tell us the story of what's going on. Profits of the practice, gross and net. You know, this is another key metric. You could have excellent revenue and we could see revenue growth, but there might not be any profit in the practice. So we need to understand where that profit's going, why that's happening, and that's really what the valuation is all about. It's painting and telling the story. Okay. Services offered. Are there certain procedures you're currently doing that the next buyer might not be able to do? Or are there services you're not currently performing that somebody could come in and do and drive up revenue? Compensation of the doctors. Are you paying your doctors at market rate? Is that fair market value? We take a look, say, okay, what are you paying your docs? What are you paying these individuals? Is that at market rate? Because if it's not, we're going to make an adjustment to make sure that we can show this as if these people were to leave and you had to replace them, what's the true amount that you would end up having to pay them? Okay. Number of employees and what they do. So here we're talking about the team, and obviously the team is critical to any dental practice. It helps make the organization run. Are they committed long-term staff, or maybe they have a shorter runway? Maybe you have some revenue producers, some associate docs with a shorter runway, and they're getting close to retirement. And if you were to sell and you're going to leave, you know, does that maybe push them to want to look to leave and transition out as well? So these are all things that we got to consider because those items certainly do impact value. And equipment, is your equipment outdated? Is it newer? That impacts value. We take a look at that. And then rent's another big one. A lot of dental practices, the owner tends to own the building, or we do see it a fair amount where the owner's owning the real estate. So are you paying yourself fair market rent, right? And what is fair market rent? Well, maybe we need to have a rent study done and say, okay, this is what we believe is fair rent. And if you're not paying that, we make an adjustment to the statements to make sure that we adjust and normalize those statements to be fair market rent. So just a little bit of a flavor of what we're looking for as we do this. Next is the normalizing activity model. So these are, again, we take the financial statements and we start to massage them and we start to look at them and say, okay, what are you really going to spin off for a new buyer? And so we're trying to accurately reflect the revenue and the expenses of the practice. So we start with compensation's a big one. Again, are we paying out all the compensation at year end? Is the compensation at market value? We need to evaluate and make sure the doctor comp is being accurately reflected to market compensation. Rent adjustment, we just spent some time on that. But again, we're making sure rent's at fair value. If the doc's owning it, we want to make sure that fair market rent is being paid. If it's not being paid, we simply make an adjustment and we impact the value to say, here's what we would have to adjust it to, because a new buyer would have to pay X coming in to own this practice. Okay. And then we look for some one-time adjustments. So we look for some non-recurring fees that should be adjusted. Maybe you've incurred a large legal fee a year or two ago, maybe some accounting fees, maybe one-time large expenses. We go through those. They'll stand out in the 5-year trend analysis, say, okay, all of a sudden we see something spiked. We'll have a conversation usually with the practice owner, figure out what's going on there. And if it is a one-time expense, we'll make an adjustment there. The goal there is we don't want to impact the value of the practice. And, obviously if it's a higher expense, we don't want to drive the value down for a one-time expense that's not going to be recurring. We're really looking for things that are going to be recurring. And again, talking about sustainability and quality of the earnings, that's what we're trying to do. We're trying to make sure we have a good picture being painted of what the earnings are going to be. And then last bullet point, any other adjustments. So, this could be, do you have a family member on payroll? Are they actually doing productivity at the office? Are they necessary? Maybe that family member is on the payroll, but they work 1 day a week. And if that individual was removed, would the practice suffer any impact, right? If not, we would take that expense. We'd want to remove it, okay? So current valuation trends, we have the corporate buyer or a strategic buyer on one side, and then we have the private buyer, which includes, selling to other dentists on the other side. When you look at this process, if you're the seller and you start to evaluate, how am I going to sell? Where am I going to sell my practice to? The corporate buyer is usually willing to put a higher value on the practice as they have synergies that they're looking to leverage. Okay, so there could be deals in place that they might have deals in place with certain vendors that they can get cheaper supplies than what you're able to obtain right now. They may have a legal or an accounting department, so they can start to eliminate some of the professional fees. And they could even have a practice model in place that they don't need the practice manager or the business manager, so they could eliminate salaries maybe behind the scene. But ultimately, the corporate buyer has a structure in place that's going to allow them to prosper and kind of take your practice and blend it right into something that they already have, okay? The private buyer, on the other side, this is where you kind of think doctor-to-doctor transaction. They usually don't have that kind of buying power. They're usually offering a lower value than the corporate buyer. They don't have the synergies or the ability to leverage like the corporate buyer does, so the prices tend to be a little bit lower, which begs the question, then which one's right for you, right? Well, that is going to be, from a seller perspective, completely up to your discretion. What are you looking for long term? Are you looking to maximize top dollar? If so, maybe you're looking to sell to a corporate buyer. Are you looking to keep your practice private? Maybe you think private, the associate that's currently in your building will do a great job and transition and take care of your patients, and that's what you're ultimately concerned about. And if that's the case, maybe you're on the private side. So it's one of those, what do you value and what are you looking for during that exit strategy? The last thing on this, it's important that multiples are dependent on a lot of different variables, right? So corporate buyers, you hear a lot of these buzzwords, X times EBITDA, et cetera, but a lot of this isn't a one size fits all. It's how much, there's variables that we consider. How much is your revenue practice producing? How many dentists do you have? How many different locations are you operating out of? All these things combined impact the value when somebody's coming in to say, I'm interested in your practice. Here's what I'll give you. They're looking at all these different things. Okay. So why should a practice want to know this information, and when should a practice be valued? Most important here is to not wait, right? you're on this webinar, maybe you're getting close to retirement or you're starting to think about retirement. But even if you're not, what can you be doing now to start driving value? Because maybe at some point private equity comes knocking and you want to make sure you get top dollar. Well, here, this wheel here is showing you the different reasons that you could start to think about this. Ready to retire, you need a succession plan. You're bringing on another doc. Maybe they're an employee right now, but you want to have them buy in and become an owner with you. So what is the practice truly worth? Prepare for sale in the future. Kind of just talked about that. Interested in buying a practice. Maybe you want to buy a practice and grow a little bit more. So what are things that you can look for in the buying process? And then focusing on adding value to your practice over time. Again, maybe you have a longer runway, but you want to get the ball rolling downhill and say, okay, I'm going to start doing some of these value drivers now so I can start to make sure that my practice is ready when it comes time to transition. Okay, so we're going to talk about some of those key drivers of business value next, and I'm going to turn it over to Matt, and he'll kind of walk through some of that.
Great. Thanks, James. So as we've talked through just more in general what's going to drive value, what that valuation process looks like. But as we get into the more specifics, within your practice, what does this look like, and what to think about? Remember that first and foremost, their financial performance alone is not the only thing that drives value. So a highly profitable practice, that's not the only important piece to think about. There's a lot of other ways to impact value here, and other ways they're going to drive strong financial performance into an even better price for the practice. What buyers are looking for is recurring, predictable income, consistent earnings within a business, sustainability and quality in those earnings within a business, which in general positions the dental industry very well to stand up very well as we go through this valuation process, because generally very consistent performance as patients are coming back every 6 months on recall. So that tends to work very well and really is supported within practices. But we're going to see this, James talked about getting 5 years worth of financial statements. Anybody who's doing that valuation process is going to see this when they look at those financial statements over time, and hopefully see strong performance on the top line in terms of revenue in the financial statements, and then also towards the bottom line in terms of actual profit in the practice that's going to drive value. So that's the first thing to consider, is that consistent quality earnings in the practice are going to drive value. The other big piece here, one of the other big pieces, is transferability. How important is it for you to be the owner and be there in the practice? Or how easily can we pull you out of the practice and have the practice continue to chug along at the same pace, same quality care for patients? If you're heavily involved in the practice and you need to be there every day, not just to see patients, but to manage staff and make sure that bills are going out and accounts are being collected on, that's not going to hold up as well in the valuation process as a practice where you'd be able to step away, and because of the systems, the processes, the procedures, a number of management or high-level employees you have in that practice who can take over and run all of those processes without you, that kind of practice is going to hold up much better when we look at value. If we can plug in a different person into that ownership role, or a different person into the role of doing the dentistry in the practice, and the practice doesn't miss a beat and doesn't suffer at all, that practice is really going to hold up well when it goes through this valuation process. So those businesses with a robust infrastructure that have scalable systems, that have processes, procedures, internal controls, are going to command that higher value, because they're going to reduce the perceived risk for a new buyer. And they're going to give that new buyer a high level of confidence that the practice is going to continue to perform well into the future. And it's going to be a good signal that that business can continue to operate successfully under new ownership. Some other key values that are going to drive value in a practice: top line revenue growth over time. Buyers tend to value a practice that's growing on the top line and either seeing more patients or generating more revenue because of the services provided than they are a practice that's seeing decline on the top line. Buyers are going to look for a healthy level of new patients in the practice. That's going to be really important as we look at that. The services provided in the practice and whether or not the new buyer can do any of that or is going to have to refer any of that out is going to be really important. If you're a practice that does some of the ortho, some of the extraction work in-house, but the buyer looking at it can't do that work, they might look at value for that practice a little bit differently if they know some of that revenue is going to have to get referred out the moment they take over. The other thing to think about here too is if you're not doing any of that extra work within your practice and a new buyer's coming in, the new buyer's probably not going to be as excited about paying for the opportunity to potentially do that work in the business instead of refer it out. You're going to get a better value if you're already doing that work within the practice. It can show the buyer what it's really going to generate on the financial statements. We talked a little bit about that facility lease transferability. That's really important to know that the practice still has a home and that the moment the buyer buys it, they don't have to walk it over to somewhere else and relocate the practice. And then we've got up here the transition plan of the seller. That can be really important too. And depends in part on who you're talking to as a potential buyer, how that might play out. As a seller, if your intention is to be able to walk away on the day of sale, that might be valued a little bit different in this process than a seller who wants to sell the practice but stay on as a provider and a full-time employee within the practice for a long period of time. So that might play into value too. It's going to play into what you get out of the whole transaction being employed there for that period of time, but it will definitely impact value. As we think through this, we really like to think of a 3-year window ahead of that potential sale to really help drive value in the practice. Things to think about there are everything that's going to drive the top line and the bottom line in a positive direction over that 3-year period. What are we doing to maximize production and revenue in the practice? Growing the patient base and having those new patients constantly coming in, looking at what we can do to trim the overhead, making sure if we sign a new lease in that period of time that it's one that will actually be transferable, and getting that support team ready to assist in the sale. Your CPA, accountant, your attorney, your banker, all those important pieces that are going to be involved in helping you get the practice ready for sale, helping you through that sales process, and then helping support you once the sale goes through. So lots of great steps that can be taken to help increase and drive the value of the practice, but we're going to want some runway to help do that. So it's not something we want to start thinking about 3 months or 3 weeks before that potential sale, but if we can get that 3-year window to really make an impact on the practice, that's when we really start to see a benefit. So we've got just a couple minutes left here. With that, again, just a reminder, if you've got potential questions for us, please chat those in. We'd love to try and answer a few here in the few minutes that are left. We've had a couple come in, James, so I'm going to throw a couple at you, get your thoughts here.
Sure.
One question, if I own my own building, if I own the space the practice is in, does that help or hurt me from a practice value perspective?
So we would look at that, see, does it help or hurt? I mean, it's definitely going to help from the aspect of getting more revenue or more money into your pocket on the exit if you're selling the real estate as you go out. But ultimately, we're really going to look at, is that practice at fair rent? So it goes kind of back to that analysis and talking about what's fair rent. Are you paying yourself fair rent? If not, we're going to want to adjust it and make sure we get it up to rent. One thing that we didn't mention, we kind of talked a lot about too, and I know this isn't pertaining necessarily to that question, but I do want to reiterate it is, this is the time too to take a look at your financial statements and how your data is being presented to you. 5 years of data going back and trying to respin it out to be in better shape for somebody to do a valuation is difficult. So, if your financial data isn't in great shape or it's not in good order, where it's not very clear and concise, start to look at that and start to consider how you can carve that out. Maybe you need some tips or you want some assistance on that. SVA can certainly do that. And we do this for many of our dental practices that we help generate monthly or quarterly financial statements to say, here, these are great benchmarks for you to use, and you can compare to the industry. So just something else we'd want to consider too.
Sure, that's great. I think we got time. I'll squeeze one more in here. If my practice is doing fine financially, does that automatically mean it's valuable?
Yeah. There's value there, obviously. There's value in the practice, but it doesn't mean that it depends on what you define as valuable, right? Yes and no. You could certainly take a look and say, yep, this is for, if we did a rule of thumb, we could look at your revenue and say, how does it compare to the industry? Oh, yeah, you could sell it for X. However, really getting involved into the detail and saying, somebody says it's valuable, but let's let the historical data and forward-looking process really paint the story and say, yes, this is what we see. This is where some of the shortfalls are. This is how you could improve it over the next year or two if you're looking to drive revenue and drive value because you have a 24-month window. Let's start now getting the ball rolling. It may be valuable, but we could maybe make it even more valuable.
Great. Thank you again, everyone, for joining us today. Really hope this discussion gave you a better understanding of what drives value in your dental practice and a few practical ideas you can start thinking about right away to help improve that value of your practice. This webinar actually wraps up our dental series for this time around. So if you missed any of the earlier sessions or want to revisit any of those past topics, you can find recordings of our previous webinars on our website at sva.com/dental series. As always, if you have any follow-up questions or want to talk through how any of this applies to your specific situation in your practice, we would love to connect. Please reach out. Thanks again for spending part of your day with us and enjoy the rest of your afternoon.